Investors are extremely confused in 2023. Last month's CPI, PPI, and retail sales numbers have come out, and they've shown us that not only is inflation falling and has officially peaked, but retail sales and spending has collapsed faster than anybody expected. Is this a good thing or a bad thing? That's the question I want to address in this video, because clearly there's a lot of confusion amongst investors in the stock market, which can't decide, is going into a recession actually a good thing or a bad thing? Well, as I'm about to show you in this video, it might actually be both. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I think it's important for us to understand what were the headline things the market cared about in 2020, 2021, 2022 to understand what we should be focusing on this year. As we all know, the story of 2020 was COVID, lockdowns, going into a massive recession with the market down 35% and unemployment hitting north of 6%. That followed 2021, which resulted in high inflation, ridiculous amount of spending, and people making money left, right, and center through stimulus checks and all the IPOs and companies that went public at that time. As we all know, when companies go public, that allows insiders to do stock sales and raise a lot more money than they could have ever done in the private markets. That increases the wealth of most people, which as a result increases spending. And because the COVID lockdowns also prevented some manufacturing facilities from coming online, this resulted in a stark imbalance in the supply chain, resulting in CPI inflation. And because higher spending equates to more profits and better gross margins for most companies, the S&P 500 had a record-breaking 29% return throughout 2021. And that is obviously until 2022, when inflation hit a 40-year high, and the Fed, for the first time in December of 2021, said they would actually consider raising the federal funds rate to a level they had not seen since 2008. And obviously, any basic macroeconomic expert should be able to tell you that inflationary periods are not good for unprofitable companies, especially those that have to raise cash and that are probably in early stages of revenue. That resulted in the ARK Innovation ETF collapsing and peaking in Feb of 2021, which, by the way, was the same month that CPI actually started to go up. As you can see, the ARK Innovation ETF is a perfect example of the roller coaster ride it's been for us being a growth stock and unprofitable company investor. Yes, don't get me wrong, investing in such companies is not for everybody, but even if you invest in profitable large cap tech stocks, this index is something you want to keep your eye on, because clearly, as you can see, with the insane volume we've seen over the past few years, investors are using this as the barometer for risk assets in the stock market. And as is abundantly clear, inflation and interest rates were the number one enemy for Cathie Wood and her fund. This resulted in risk assets like IPOs, early pre-revenue companies, to get absolutely destroyed in 2021, because when investors get a better return from the bond market and the US government, who's going to buy unprofitable companies and speculate on their revenue and profit growth, which obviously is extremely difficult when interest rates are going up. And that is obviously the entire story of 2022. Not only did growth stocks get destroyed, but even companies that are so well established, like Meta, Amazon, and obviously even Tesla, got absolutely wrecked in the second half of 2022. All this from inflation and the fact that the Federal Reserve was way too late in judging how sticky their stimulus check printing would truly be. But now in 2023, the story is flipping completely on its head. We're now going into a time when inflation has peaked. The interest rate hikes that we're expected to see are not going to be as aggressive as last year, and companies, unlike over the past 3 years, are actually laying off people and reducing their profit expectations. This is obviously all a result of higher interest rates reducing the appetite for people to spend the money and lockdowns being eased in one of the biggest economies in the world, being China. This results in an excessive amount of supply of goods that were initially in high demand last year. This has already been seen in the supply chain situation, which has improved significantly, meaning lead times have fallen and overall component shortages have collapsed, particularly in the consumer electronics industry. And because now people have less savings than ever before and a lot of demand was pulled forward for the past 2 years, it's no surprise that retail sales are collapsing. And if you're an investor in the stock market for the long term, whether that be index funds or individual stocks, this is exactly what you want to see. And I think many people are misunderstanding that. Because I think people are misunderstanding the fact that inflation and recessions are exactly the opposite of each other. Inflation happens because of non-recessionary events that lead to an imbalance in prices. And a recession happens when inflation falls because of declining consumer spending, which is obviously the biggest component of US GDP. And obviously, a 2-quarter decline in GDP is technically considered a recession, of which we already saw happen slightly last year. And as you can clearly see, manufacturing prices represented by the Producer Price Index peaked in June of 2022 and have fallen significantly, almost cut in half over the past 12 months, which is exactly what we need for inflation to fall. And obviously, this isn't going to come at the expense of a strong economy. The economy is obviously going to suffer from this. So the retail sales data that is coming in lower than expected should be of absolutely no surprise, because that is the byproduct of raising interest rates, which is what the Fed is trying to do. The Fed actually wants to see data like that because it means they can keep the terminal rate potentially stable for 2023 and start cutting if the situation starts to get worse in 2024. Now, trust me, just like you, I don't really trust them to be able to handle this situation perfectly. So it is probably not going to be a soft landing, and there's going to be companies that are going bankrupt as a result of this. But that is exactly the time to be opportunistic as an investor. This is a recession, believe it or not. Inflation coming down more than 5% within a 12-month span always is led by a recession. And that, for me, to be honest, is creating more of an investment opportunity than before. I now know that I'm actually buying investments in a time of recession when prices are going down and when overall optimism is at all-time lows. I'm not talking about optimism from traders or even investors in the short term. I'm talking about optimism from a macroeconomic perspective from long-term investors. You look at the commentary of any Fed official or any big fund manager, whether that be JP Morgan or Blackstone, everybody's warning us of this impending recession in 2023. And although in the short term it sucks to buy when prices continue to go down, in the long term, this is what you need to do to be the successful investor you want to be. This isn't a game for everybody, and I just want to remind you all that regardless of what kind of investment you're picking, whether that be real estate, make sure you stick to your conviction and don't let macroeconomic BS that's going on right now dissuade you from continuing to invest in what you like and what you understand. This has led to a lot of people to lose money on paper over the past year, and I don't want that to translate into people losing real money in a time of opportunity, as we have seen countless times over the past 100 years. As you can see, every single time inflation and CPI is inflecting from a relative high, it's always during time or right before a recession is declared. And guess what? This recession is not going to be declared probably until 2025. The government and the administration today don't want to call out a recession because obviously consumers are already hurting from high inflation and the pandemic-induced loss of life. So in my opinion, completely forget the politics, forget what the media is telling you and all these contrarian opinions from analysts, when we know that the Fed actually wants a recession to bring down inflation, which will help ease the rate hikes. Now, there are chances some companies will continue to see EPS declines throughout this year, meaning earnings could be more difficult for certain companies because, as you can see, for the S&P 500, based on the third quarter of 2022, the percentage decline in EPS is actually nowhere near close we've seen in the past few recessions. But we also need to keep in mind that this recessionary and inflationary period was forced by a pandemic that we haven't seen in the past 40 years as seen on this chart. So you always want to take every single event with a grain of salt. History can repeat itself, but as we all know, what actually tends to happen is that history rhymes, meaning you will see similar trends and patterns in the market and in social media, but you're probably not going to see the exact same results. So obviously you want to tread with caution and pick the right companies and not overinvest in one specific business. But what is somewhat confidence-inducing is the fact that it turns out firms like Morgan Stanley are already predicting this kind of recessionary decline in EPS that is potentially going to stay at the same rate of decline as we've already seen in 2022. But as you can see right now, Morgan Stanley, for example, is pricing in that this rate of decline is going to continue throughout 2023. Now, don't get me wrong, this can certainly happen, and this is certainly a reason why companies are selling off like crazy, but this also tells us maybe the worst is being priced in by most of Wall Street. On the other hand, this 2023 recession is actually talked about a lot more than you would expect, telling me it might not be as severe as many people expect. Earnings are definitely going to decline, and some companies will definitely miss on earnings. Don't get me wrong about that. But the opportunity is always found in crises. Company earnings have always declined during recessions, but that does not necessarily mean that equity valuations or even real estate prices can't rebound the years after. And guess what? With the surprises we're seeing from companies like Meta and now Netflix, who blew away expectations for subscriber numbers, it could be that this current tech recession is just not as severe as most of Wall Street is predicting. This is just an opinion from me, and things can certainly change because companies are different, businesses are priced differently. But it's certainly true that you want to really pay attention to the upcoming earnings season in February, because historically Q4 tends to be the biggest growth year for companies, and as a result, their full year guidances are going to set the tone for how investors are going to interpret inflation and the recessionary forces. Because it's pretty clear that right now, the market is now all of a sudden focusing on this recession rather than inflation, which in my opinion is a good thing because it means you might be getting better deals than you initially thought. Because obviously, I will say it once again, the main focus of the Fed was indeed to induce a recession and bring down inflation, which obviously was the number one reason markets fell throughout 2022. And trust me, even if markets do rally throughout 2023, you will see a lot of fear and FUD around this recessionary data. Because people don't realize markets tend to run 6 months ahead of time, and chances are this recession could have been priced in, meaning if markets do go up, it's not necessarily just a trap for investors. It might actually be the market rally that takes us out of this bear market, which actually already has been the reality for the Hang Seng Index and the Indian stock market out in Asia. And I think there's a high likelihood that the US is going to follow what those Asian markets are doing. But as usual, guys, this is just my take, so let me know your thoughts down in the comment section below.